6 weeks ago, Kioxia was the most valuable company in Japan. It had risen more than 70 times over since going public in 18 months. Today, it has lost more than $200 billion in market value, well over half the company, and it has fallen to 6th place. So the obvious guess is that something broke. Demand collapsed. Prices fell. The story ended. Except none of that happened. The price of the thing Kioxia actually sells, flash memory, is still going up. Contract prices roughly quadrupled over 3 quarters and rose another 70% in the last one alone. The company's revenue has more than quintupled in a year. Last quarter, it cleared 1.77 trillion yen, the biggest quarter in its history. So how does a company get cut in half while the price of its product is still climbing? That's not a contradiction. It's a pattern, and it has had a name for almost 100 years. Here's what this video is going to do. We're not going to tell you where the stock goes next. We're going to explain the mechanism, why a market can be starved of a product and terrified of that same product at the same time. Because in June, something changed. It wasn't demand. It was that everyone in the industry announced, almost simultaneously, that they were going to build more factories. And the moment you can see the new supply coming, the market stops pricing today and starts pricing the day it arrives. That gap between when a price rises and when the supply finally shows up is the single most reliable pattern in the history of commodity markets. It has taken down hog farmers, egg producers, lumber mills, and shipping lines. The question is whether it is about to take down a memory chip company. Welcome to Tokyo Tickers, where the best stock in Japan and the scariest one are the same company. Let's put the numbers down first, because the scale is genuinely hard to hold in your head. Kioxia makes NAND flash, the memory that stores data. Not the fast memory a chip thinks with, the memory that remembers. It's the former memory division of Toshiba, sold off in 2018, and it only listed on the Tokyo Stock Exchange in December 2024. Very recent. On June 22, 2026, the stock hit an all-time high of 112,700 yen. At that moment, it was up more than 660% for the year, more than 70 times its IPO price of 1,455 yen. And its market value had briefly passed 60 trillion yen, 10 trillion of which it added in the previous 6 days. That was enough, briefly, to make it the most valuable listed company in Japan, bigger than Toyota. Then it went the other way, and fast. In under a month, it was cut in half. At the low in late July, it was down about 65% from the high, roughly 35 trillion yen, more than $200 billion of market value simply stopped existing. It fell from first place in Japan to 6th. And here's the detail that makes this episode worth your time. Through all of that, the fundamentals did not deteriorate. They improved. To understand the fall, you have to take the rise seriously, because the rise was not a fantasy. 3 real things happened at once. First, AI created a new kind of demand for storage. Everyone focuses on the expensive chips that do the thinking, but a model has to be trained on something, and that something has to physically sit somewhere. Data centers needed enormous amounts of high-capacity storage, and they needed it immediately. Second, supply went the wrong way. Samsung announced it was ending its MLC NAND products, with final shipments in mid-2026. Total capacity for that category is forecast to fall over 40% this year. Third, and this is the part people miss, the industry's wafer capacity got pulled toward high bandwidth memory for AI accelerators, because that's where the margin is. Making one HBM4 chip consumes roughly 3 times the wafer capacity of an ordinary DRAM chip. So the factories were full, and they were full of something else. The result was one of the sharpest price moves this industry has ever recorded. NAND contract prices rose roughly 70 to 75% in a single quarter. Stack the last 3 quarters together and prices are up somewhere around 4.5 times. Kioxia's revenue crossed 1 trillion yen in a quarter for the first time, and then in the quarter after that, reached 1.77 trillion. That is more than 5 times the same quarter a year earlier. Operating profit went from 45 billion yen to 1.27 trillion, an operating margin of 75%. For a memory company, that is not a good number. It is an unrecognizable one. Kioxia's public position is that NAND stays tight into 2027, so real demand, real shortage, real profits. Nothing about the rise was fake. So let's leave semiconductors for a few minutes, because the thing that is happening to Kioxia was first written down in 1928, and it had nothing to do with technology. It had to do with pigs. A German researcher named Arthur Hanau wrote a dissertation on the Berlin hog market, and he noticed something strange. Hog prices didn't drift toward a stable level. They oscillated, almost mechanically, in a repeating cycle. The reason was a lag. A farmer decides whether to breed based on the price he can see today. But a pig takes about 114 days to arrive, so when prices are high, every farmer breeds. And then, 4 months later, all of those pigs show up at the market on roughly the same day, and the price collapses. Then every farmer stops breeding, and 4 months after that, there aren't enough pigs, and the price spikes again. In 1934, Nicholas Kaldor gave this a name. Plot the prices and quantities on a chart and the line spirals in a shape that looks like a spider's web. He called it the cobweb theorem. If that sounds abstract, it isn't. It happened last year in your grocery store. In early 2025, avian flu killed about 50 million egg-laying hens in the United States. Eggs hit $8.15 a dozen, an all-time record. Now, what does every producer in the country do when eggs are $8? They add hens. The national flock went from about 292 million birds to roughly 308 million, and the hens arrived. By January 2026, the average price was $2.58, down about 59% from the record. By February, more than 80% below the peak, back to where prices were before the outbreak. And the story does not end with cheap eggs. Producers who expanded into the shortage are now the ones in financial distress. The shortage created the surplus that punished the people who solved the shortage. Same shape, different product, over and over. Lumber peaked at $1,670 per thousand board feet in May 2021, about 4 times its pre-pandemic level, then fell more than 40% in June alone, the worst month on record for that market since 1978, and eventually gave back around 70%. Ocean shipping went from $4,000 a container to roughly $20,000, and back to about $4,000. And the memory industry has its own version, which it has run through repeatedly. A demand-driven boom lasting 4 to 7 quarters, then an oversupply bust lasting 4 to 8, with revenue falling 25 to 40%. A down cycle roughly every 3 to 4 years. In 2019, DRAM prices fell 50%. This is not an exotic risk. For this industry, it is the base case. So why June? Why did it turn in that specific month when prices were still rising? 3 things happened. The first was a rumor. In late June, speculation started circulating that OpenAI's IPO might be delayed. That alone knocked 12% off Kioxia in a single session, and it dragged Samsung and SK Hynix down with it, which tells you something important about what people thought they owned. They didn't think they owned a storage company. They thought they owned a leveraged bet on the AI build-out continuing exactly on schedule. The second was the seller. Bain Capital sold its entire remaining stake in Kioxia. To understand why that landed the way it did, you have to know the history. In 2018, a Bain-led group bought Toshiba's memory business for $18 billion. They had owned this company for 8 years. They knew the fabs, the yields, the customer contracts, the roadmap, everything. In December, they held around 44%. By mid-June, about 14%. By early July, 0%. total profit, reportedly north of $15 billion, one of the most lucrative private equity exits in the history of the semiconductor industry. Now, a seller exiting is not, by itself, a statement about the future. Funds have to return capital eventually. But the market did not read it neutrally. The market read it as, the people who know this asset best just finished selling all of it, right at the top. And the third, the one that actually matters for the next 5 years, was the factories. In the space of a few weeks, the industry announced its supply response. SK hynix committed roughly 80 trillion won, about $51 billion, to a new NAND fab called M17. Construction starts in 2027. Operations begin in the first half of 2029. Alongside it, 100 trillion won of broader investment. Samsung and SK hynix together laid out Korean expansion plans, measured in the hundreds of billions of dollars. TSMC raised its capital spending outlook. And Kioxia itself is not sitting still. It's targeting around 470 billion yen of capital expenditure per year through fiscal 2028, up about 66%, roughly 1.4 trillion yen in total, and it has been reported to be weighing a third fab at Kitakami. Every one of those announcements is individually rational. Collectively, they are the second half of the cobweb. So, does Kioxia fit the pattern? Honestly, partly. And the part where it doesn't fit is the most interesting part. Here's what matches. High prices, yes. A simultaneous, industry-wide capacity response, yes, explicitly announced. A history of the same product doing exactly this, yes, repeatedly. Every ingredient of the cobweb is present and documented. Now here's what doesn't match, and it's the thing almost every headline gets wrong. It's the length of the lag. A pig takes 114 days. A hen takes several months. A sawmill can add a shift. A semiconductor fabrication plant takes 4 to 5 years and $50 billion. And the one SK hynix just announced does not produce a single commercial wafer until 2029. So the supply that broke this stock in July is not arriving in 2026. It is not arriving in 2027. Kioxia's own guidance says the market stays tight into 2027, and independent forecasts agree the new fabs don't reach meaningful volume until late 2026 or 2027, with priority going to the higher margin AI products anyway. Which brings us to the actual answer to the question in the title. The stock did not fall because the shortage ended. The stock fell because the shortage's expiration date became visible. Those are completely different events, and they happen years apart. A commodity price tells you what is true right now. A share price is an attempt to price every year that follows, discounted back into a single number today. So the moment the industry stood up and said, in public, here is exactly how much capacity we are adding, and here is the year it switches on, the market took 2029 and moved it into today's price. That is not irrational. That is precisely what a stock market is for. And on July 31st, we got the cleanest illustration of that yet. Kioxia reported the quarter. Revenue, 1.77 trillion yen, more than 5 times a year earlier. Operating profit, 1.27 trillion, against 45 billion the year before. An operating margin of 75%. By any ordinary standard, one of the most profitable quarters a Japanese manufacturer has ever printed. And the number the market spent that day on was none of those. It was the guide for the next quarter, 1.89 trillion yen of operating profit, against an analyst consensus of 1.95, a shortfall of about 3%, on a figure that had risen roughly 28 times in a year. The same day, the company announced a share buyback of up to 800 billion yen, around 5.5% of its shares, running from August the 3rd to October the 30th, and a 3-for-1 stock split effective the 1st of October. Those are announcements, not outcomes. Where the stock goes from here is not something this channel will tell you. What that single day does show you is the mechanism, working in public. A company can post a record quarter and still trade on a number 3 months away. One more number belongs on the table because it cuts the other way. NAND contract prices are still rising, but the forecast for the current quarter is 10 to 15%, against 70 to 75 in the quarter before it. Still up more slowly. Whether that is the top of the curve or a pause in the middle of it is not something anyone can tell you in advance. That uncertainty is the lag. There is a genuine counter-argument, and it deserves to be stated properly rather than dismissed. It's that AI has changed the demand side permanently, not cyclically. The strongest version of it is not a slogan, it's arithmetic. High bandwidth memory consumes roughly 3 times the wafer capacity per chip. So as AI takes a larger share of the mix, the industry needs disproportionately more factory to deliver the same number of bits. Micron has said its HBM capacity is fully sold out for the year. Kioxia is guiding for data center demand growth of more than 20% a year through 2028. If that holds, the new fabs don't create a glut. They barely keep up. Analysts, for whatever it is worth, currently carry an average target price roughly 2.5 times where the stock trades today. Nobody in this debate is being stupid. The bulls and the bears are looking at the same fabs and disagreeing about one variable: whether demand in 2029 is bigger than the supply that shows up in 2029. So if you came here wondering how a company loses $200 billion while its business is getting better, that's the answer. Nothing broke. The market simply finished pricing the good news and started pricing what the good news causes. High prices are not a reward that markets hand out and leave alone. They're an instruction. They tell every producer on Earth to build, and the building always, eventually, ends the thing that paid for it. The only variable that ever really matters is how long eventually takes. For a hog, it's 114 days. For a hen, about a year. For a memory fab, it's the back half of this decade. None of this is investment advice. It's a way to understand why the price of a company and the price of its product can point in opposite directions, and why that is usually the most informative thing on the screen. Follow Tokyo tickers. Japan explained for global investors. Every shortage quietly builds the factory that ends it.